So with that, I have nothing else, so we'll turn the time over to Craig and our program. Thank you.
Well, I'm excited today to have Fred Dickson come back and speak to us. He spoke to us several years ago. He's the Chief Investment Strategist at D.A. Davidson, and he's been in the securities industry for 42 years, so he has excellent experience to talk on this subject. He was previously D.A. Davidson's Director of Research in the 1990s. He began his career by working for 10 years with Goldman Sachs' top-ranked investment strategy team, and he's currently a trustee for the Securities Industry Institute at the Wharton School of Business. So please help me welcome Fred Dickson.
Oh, thanks, Craig. I was here 2 years ago. What a wonderful turnout, and it's always a pleasure to come back to Twin Falls. I was thinking back when I was here before, I came on a very, very big day for the city, because that was the day the announcement came that you were going to get the Greek yogurt factory, and I understand that's up and running. So that speaks a lot for your community, and it's nice to hear that that is working its way along. I have had the opportunity, and I love speaking to Rotary clubs. Like last year when I look back at my calendar, I had the opportunity to address 22 or 23, ranging from Bellingham, Washington to downtown LA out to Omaha, Nebraska. But every club has its unique flavor, and I will give your Rotary club 2 credits. Number 1, I've had the best lunch that I've had at a Rotary club in probably the last 10 Rotary club meetings. And number 2, your technology is absolutely first rate. And I will say I've just upgraded it because I was comparing you to downtown Los Angeles, and Los Angeles does not put the events and have the coordinated slides that you have. So I think you can take a bow and congratulate your club for excellent internal meeting communication. So we'll do that. We're going to take a very fast walking tour of what we see happening in the economy, financial markets. I'll make some local comments as far as regional things that are going on regionally. And hopefully we'll have just a couple minutes at the end for some questions. But when we take a look at where we are right now, what we find is that we are just coming up to the 5th anniversary of the bull market. Boy, doesn't it seem that seems like a long time ago. At this point, 5 years ago, we were just really in the depths of the financial crisis, and we've come a long way since then. I have to remember how long ago that is. I really want to put that in way back in my memory bank, never see it again in my career. And I think at this point, a lot of the actions that were taken by Fed officials, local officials, and also by individuals have gone a long way to shore up the situation at this point in time. When I look ahead, there we go. Do I have anybody here that is with one of the regulatory agencies, SEC, FINRA, State of Idaho Regulatory Board? If you did, I would invite you to leave. No. The bottom line is, for legal purposes, I have to have a disclosure statement. What it says is the data that I'm going to be presenting and talking about, I believe, is reliable. I don't guarantee its accuracy. I don't guarantee the accuracy of the forecast. And our forecasts may change over time. So now I am legal. I can drive to Boise a little bit later with a clear head. Just a minute or two on last year. It was a year of incredible challenges and surprises. I will confess, I was looking, and had I been here this time last year, I would have told you that we were expecting to have a decent stock market year in an economy that would have a lot of ups and downs, bumps and bruises, but we would manage to ride over that. Little did I know we were going to have a year that produced the stock market that ended up at record levels. Again, when I went back and I looked at my notes from 2 years ago, I got up, and some of you came up to me and said, I can't believe that you're as bullish as you are. And I was not outrageously bullish, but I said, I think we're on a long journey here that probably will lift the market averages to new all-time highs. Well, we saw that happen at the end of last year, maybe a year or two ahead of my schedule, but the bottom line was the Dow, the S&P, the NASDAQ, Russell 2000 and others hit a new all-time, including an index that we've put together at D.A. Davidson and have had in place now for 10 years. We call it the DAD 99. You forget round numbers. I like weird odd numbers like 99. But 99 of the top companies in the Pacific Northwest, including, I believe I have 8 from Idaho in that index. That index also ended up at an all-time high. And frankly, it was the best performing index that we had last year. That reflected what we saw going on in the economy. We saw unemployment came down in your state. We saw the region itself pick up, maybe a little bit slower than some parts of the country, but we benefited through the Rocky Mountain and Pacific Northwest from a growth in aerospace, from a rebound in technology, particularly in the Seattle-Portland area, also over in Boise. That felt a whole lot better. A rebound in housing, and what we saw also was a rebound in materials and the trades that had to do with building products going into home construction, commercial construction, and export construction. And when we look at these companies and put them together, they had a good year. And frankly, what is even better was that around the country, investors recognized that, buying stocks of the companies that were centered in this particular region. Like I said, I was expecting last year to be a good year, but not a spectacular year. These are spectacular numbers. This year, I'm telling our clients, do not expect the same. We expect the market to actually be okay, the economy to be a little bit better, but I'm not looking for the big numbers. You might look at the end of the bottom of the chart. The big laggard and the big surprise was the 28% drop in gold. And I get a lot of questions, is it over? What caused it? Oh my goodness, gold is only supposed to go up. Remember those commercials of a couple years ago? Gold on a per ounce basis is going to be up at $3,000 an ounce, etc. Well, I know in Portland we were absolutely besieged with those commercials. I don't hear any commercials now, especially with the market down 28%. Maybe we should be hearing some of those. The bottom line was two great big governments that hold a lot of gold decided last year was the year they were going to sell, and that was Russia and India. Market events, just a couple that we'll touch. One that we saw hit last year at the beginning of the year that had played out, and it really worked out really quite well for all of us. And that was the, what I'm going to say, the fiscal cliff. Ooh, I hate those words. But we've actually dangled over the fiscal cliff for 2 or 3 days. That was when Congress had to, we found that the marginal tax act, or let's say our marginal tax rates were going to expire at the end of 2012. They had to be renewed or adjusted or changed, and for 98.5% of us, it had no impact whatsoever. Fears that the tax rates were going to go sky high, particularly for middle income holders and holders of stocks and bonds through dividends and capital gains, just plain did not materialize, again, for about 99% of us. We had a weird experience last year. We had another food fight in Washington. We found that Congress couldn't take and come to an agreement on extending the debt ceiling or funding the government, so we had this government shutdown for a while. That was supposed to be a economy killer, and frankly, we rolled right through that one as well. What we had going on last year, and it's continuing this year at an ever so slightly pace, was the Federal Reserve stepping in, and they take this fire hose, and I mean a fire hose. I'm a big man, but imagine the Federal Reserve with all its strength pumping $85 billion a month into the economy and doing that for an entire year. At the beginning of last year, it was just barely getting started. We thought it would happen for a month or two. It has continued, and it is continuing today, albeit, though, at a slightly slower pace. So there is a lot of money being flowed into the economy. A lot of that has been locked up in Federal Reserve Bank reserves in New York. Hasn't made its way through the economy, but some of it has, and that cushion of money allowed the market to float up and over some of the speed bumps that I just mentioned, allowing investors to enjoy a good year and kind of riding out without feeling the waves or the storms in the economy that was happening below it. I'm going to skip a couple of the charts. I want to get to a couple that are really important right now. Well, the stock market is at an all-time high, and it's now pulled back ever so slightly. Well, not a surprise that it pulled back ever so slightly. If you've had a 35 or 40% run without a pause, don't you think it's time to take a rest? Well, investors at this point did, and they chose the first month to kind of do that. Had that pause happened in April, May, or June, we probably wouldn't have heard a whole lot about it. But since it happened in January, and it's a new year, and everybody's getting pumped and wondering what's going to happen, and a lot of financial writers are going to say, they write and they say, gee, what happens in January will happen in the entire year, and it caused a lot more of an excitement. When we actually went back, looked at the numbers, what we found is, yes, January was a down month, and that was kind of a slight downer, but after a 30 to 40% year, not a big downer. The data showed that as we went back to 1929, in the years that January was down, the stock market was only down 35% of the time. Or in other words, that indicator was proven false 2/3 of the time. So we weren't really terribly concerned about it. We are concerned about valuations. I know a number of you are involved in real estate, and when we look at valuations, the real estate peaking in exuberance back in 2005 and 2006 set up the top of the economic bubble, top of the real estate bubble, and ultimately put the seeds in place for the financial collapse. I get the same question. Gee, the Dow's at a new to all-time record high. Is it as extremely overvalued in stock market terms as the housing market was in 2005 and 2006? And our answer to that is no. Yes, stock prices have moved up. They've moved up relative to earnings. The chart I have on the board shows the price that the market is paying for $1 of earnings, and it's about 15 times. That range has gone from roughly 9 times to 25 times over the last 15 years. It's about average. Not a big worry. It has moved up, and it does show in the last year an increase in confidence in the part of investors, but not dramatically so. Our sense is that price that investors are willing to pay for $1 of earnings will probably flatten out around 15 this year, and it will take the market riding on the strength of companies reporting growth in revenues and earnings this year to drive investor appetites north so they buy more stocks, not the Federal Reserve coming in with a lot of money that needs to be reinvested. Last year, I was extremely concerned about what I called the bond market bubble. Bond yields have dropped dramatically. They dropped dramatically between 1982 and summer of 2012. Back in 1982, a Treasury bond provided a coupon or a yield of 16%. Can you imagine those days? Some of us around then. I see a few people that might be slightly younger than I, but we all kind of knew what that was about. Last summer 2012, they were at 1.5%. Eventually, bond yields couldn't go a whole lot lower. They have to go up. When bond yields go up from a low base, what that does is it causes a very big spike in volatility in the bond market. And we were warning our clients, holding bonds with very long maturities, at that point in time, there was the possibility of a very big correction coming. And in fact, that did come last summer, where we saw bond portfolios drop in value by anywhere from 15 to 30%. That would be a very significant stock market equivalent correction. Our feeling is that interest rates are going to continue to go up. Bond market had overreacted, and our warning flag has gone from severe anxiety or severe warning to a moderate warning at this point. Our feeling is that bond returns probably will be flat when you look at the coupon you get from your bond and adjust or subtract that the possibility of the value going lower as interest rates go lower as you hold it in your portfolio. And that, our sense, is going to continue for about another at least 2 or 3 years as the economy continues to expand. It's not a danger sign. It's not going to torpedo the economy, but it will slow it down. And it could be painful to individuals holding a lot of bonds with a lot of long-term maturities in their portfolio. While they enjoy collecting the nice interest rate checks, we'll see the values on their statements come back down. One way of looking at the relative valuation of the risk of the bond market versus the stock market is shown in this chart. Blue line at the top is our estimate of bond price valuation that's statistically derived. And that almost looks like it's kind of a scary chart. It goes from 20 times up to about 50 times. The bottom is the valuation of the stock market. Our assessment continues to be that the bond market has about twice the amount of risk in terms of price volatility, given the fact that interest rates are low relative to the stock market. When I first put the chart together a year ago, I looked at that stock chart, and I said, man, I'm back looking at internet stocks of 15 years ago that were really off the charts on a value basis. But those are Treasury securities, the safest form of bonds, and they are still sitting at high valuation levels. Let's skip ahead. We're in 2014. Let's talk a little bit about what we're seeing right now. I sense that we're going to have a smoother sailing year. Last year we came into the year thinking about a lot of bumps that we have to deal with. Sequestration, fiscal cliff, federal debt ceiling, Cyprus. Cyprus. Learned a lot about Cyprus last year, more than I ever cared to in 5 lifetimes. We're going to have some surprises this year, but our feeling is it's going to be a smoother sailing year, and we're starting to see that play out in the economic data. Number one, we don't expect another food fight in Washington. It seems that at least we have a temporary resolution on funding the federal government. House last night passed a bill basically suspending the debt ceiling for a year. We can talk about whether that's a good thing or a bad thing, but bottom line, that will be put into effect, and that will prevent another possibility of shutting the federal government down later this year. It does not eliminate the possibility of the debate about that issue, but that debate gets Postponed to guess when? After next fall's congressional election. Are these politicians smart or are they smart? Why debate something that might cause people to get upset? Let's put it after the election. What we're seeing is that because of the recovery in the economy, and the economy ended up last year, and I'm going to try this out on you. One of the things that we saw at the end of the fourth quarter and the end of last year was our economy growing at a point where it stood at its 15th consecutive incremental all-time record high. That means over the last, since really 2010, every quarter our economy has operated at slightly higher levels of all-time record activity. Now I'm going to look at the room, stop here for a second. How many of you in this room believe that and feel that that is right? Guess what? You're the 17th audience in a row where I haven't seen a single hand raised. Isn't it interesting? We're producing more autos. We're producing more industrial products. We're growing more agricultural products. Basically putting together more building materials, selling more technology goods. And guess what, folks? You're spending more money on consumer goods than you ever had at any time in the history of our country. I haven't convinced you yet. I can see it on your faces. And we're doing it with still a fairly high unemployment rate. That means that basically our businesses, from the smallest shops like those that you're involved with to the largest companies around the country, have been able to find ways to produce more, sell more, distribute and grow more with the people that you have working for you in the cases of replacing some. I'd love to see the unemployment rate come down. What that tells me is we have the potential to grow even a lot faster. We've had an economy, it's hard, but we don't feel it because we have an economy that's going probably at 45 miles an hour and it's incrementally increased about 2 miles an hour per each quarter. When you're going from 42 to 45 miles on a back road, do you really feel that? No, you don't. That's kind of what we see in the economy. If we can get the level of confidence on the part of all of you, the part of our small businesses, our middle-sized businesses, our corporate leaders feeling good about the future and feeling good about the fact that regulatory environment is going to remain stable. We understand our taxes, and we get a big one out of the way, and that's what our health care costs are going to go. We might see some more employment there. We know what the hurdles or the barriers to growing and bringing people on board are. One is finding the right people for the right job. Have some of you had that problem? I would imagine some of you have. It's finding people the right skill set, or in the right geography for where the jobs are. And there's a third one, and I just got interviewed by the AP on this one. The third barrier of growth, it's one that doesn't get talked about, is finding employees who are willing to take the mandatory pre-employment drug tests. That is the huge and the largest barrier to employment growth that we see. In the state of Oregon, it's estimated that about 30 to 40% of those that are unemployed are unemployable because those individuals cannot pass a drug test pre-employment or are not willing to take the pre-employment drug test. And I can't tell you how many of our D.A. Davidson clients that I've talked to individually that run businesses are looking for lots of people and can't find suitable candidates who are licensed to do skilled jobs in certain areas because they will not take a drug test. I go into colleges and I say very simply to the college kids, and I've done this at the University of Idaho, I'll be doing this, I did it a week ago up at Montana State. I look at the class and I say, I know you're clean. Might as well start off with a positive comment. I know you're clean. Tell your friends and tell your family members, get clean. Marijuana stays in your body for 9 months, and the number of employers who are testing for drugs before they are hired is going up exponentially. So that number is probably at the 80 to 90% level. You wonder why kids can't get jobs coming out of college? A lot of them won't. They get up to the hurdle where they may be qualified, and they say, oh, we need to have you take a drug test. End of interview. Think about that for a moment. Let's talk about positive things. States are enjoying increasing tax revenues. We've seen that federal budget deficit, which I said is beyond monstrous and beyond belief, running at about $1.4 trillion a couple years ago, being cut now to about $500 billion. I don't know about you, but $500 billion is a big number to me. Kind of agree? Let's put it in context. It's $500 billion up against a $17 trillion economy. Well, that's a big number too. That's many, many times the size. In fact, the deficit is running at about 3% of the size of what we produce in terms of all our goods and services. And at $500 billion a year in deficit, it's a very, very small fraction of all the assets, of all the companies, of all the people, of everything here in the U.S. that runs at about $95 trillion. But it's still a big number. When we look at the overall deficit at $17 trillion, yes, that's bigger and about the same size of our economy. What bothers me is, yes, that's a big number, but number two, at some point we're really going to have to start to pay a lot of interest on that debt, which we are not paying now. The $500 billion of budget deficit that is this year could theoretically double in 3 years if the funding of our federal deficit goes from 2% to 5%. Now, can you imagine the program fight at the federal level when they have to come up and maintain deficits for political purposes at about the current level at $500 billion? Where do you take another $500 billion out of federal spending out of a $3 trillion budget? I wouldn't want to be that politician. It'll be very interesting, and I hope in 2 years when we're at national elections, or even this year in congressional elections, a educated, smart public will approach candidates and say, tell me how you're going to work the math on that one. Global economies are recovering. Short-term interest rates are low. If you're a car dealer, you must love it because you're selling cars with very, very low interest rates to a public that can now get financing even if they have low credit rating scores. About it's more than 40%. The numbers that I last saw were 60 to 70% of the cars that have been sold in replacement have gone to subprime borrowers. Not a big problem. Bigger problem that I see is the fact that we got $1 trillion of student loan debt that somehow needs to be financed. Different topic. I'd love to talk an hour on that one later on or at another time. Kind of looking down the list of good things. We see rising employment should drive rising consumer spending. And our sense is, even with the barriers that I talked about, employment should rise once employers get an idea of what healthcare costs are really going to be and see some regulatory stability, environmental, energy regulatory stability on the horizon. Inflation is tame, and here's the one I love to talk about. How many of you realize that the United States is it's kind of on the cusp. We're either the number 2 or number 3 largest oil-producing country in the world. Those statistics are staggering. We have come so far in the last 5 years, primarily as a result of what we've pulled out of the Bakken field, out of the Marcellus field and the Appalachians, new fields that are being developed in old fields. Listen to me carefully. New fields that are being developed out of old fields in Texas that they thought had run dry. That all of a sudden they're discovering down 15,000 feet, there's all kinds of oil that can be fracked out of Texas. Texas loves it. Montana loves it. North Dakota loves it. And guess what? It's a pyramid that's given us some economic foundation, adding to basically to our global stature. Oil is a very short supply around the world, even though there's a lot in reserves underground. And fortunately, we're back to the point where we are able to take and develop that. So that's a big, big deal. And you're right in an area where you are feeling the residual impact of that. Some of you may know that here in Twin Falls, you may have known people that have gone up to work in the fields. Only thing, I was in an interview this morning by that AP person about drugs, but they were really talking about the restraint of growth in developing the Bakken. And I said, well, number one, think about where it is. I was in Sheridan, Wyoming last week. It was 28 below zero at a luncheon speech. To me, that's cold. I don't know about you. Now think about it if you're working out on a pad, working for one of the major service companies and you're having to drill. I wouldn't want to be out there in that environment very long. So they're having trouble trying to keep people into that mode. They are hiring it because they're paying outrageous wages to bring people there. The turnover is high, but they continue to move ahead. All that is good. Highlights. Autos look good to us. Industrial production looks good. We're back at the point in the U.S. where we're having more companies built here, factories here in the U.S. than what we're sending abroad. Think about how that's reversed. Why can we do it? Number one, our labor costs, and this has been painful because we haven't seen big increases in labor, while around the world other producing countries that have grown very fast have had very rapid labor rates. Labor rates are finally starting to equalize. So we're competitive. Our workers are more skilled in many, many ways. We have low energy costs, we have stable taxation, and frankly, we've introduced tremendous areas of economic productivity in our factories that have resumed for new factories to become world class. A lot of that is through robotics, a lot of that is through automated software, the logistics of getting materials in, and the use of technology to control the design process. Some of us, and some of you may be aware of things like 3D printing as one of the examples. Can you imagine? Can you imagine a box sitting in the middle of a room, or a whole bunch of boxes, 200 boxes, and you put in foo-foo nanomaterial powder that's a billionth of a meter in size, and it processes it through, and it's controlled by a computer and software, and you can program it to be designing anything. Well, guess what? General Electric is doing exactly that, and they're producing great big valves, pump assemblies coming out of that metallic, stronger, more durable, more highly machined, more complex, and faster. And guess what? You don't have to pay a 3D printer Medicare costs. Good news? More productive. Bad news? What do you do with the people like he's now deceased, but my father-in-law, who was a machinist at Bethlehem Steel? There's no way he could mill a metal tolerance to the tolerance that are coming out of some of these machines. So, good news, bad news, but generally good news. Want to balance this out here in the last couple of minutes with some of the speed bumps. Interest rates are rising. That's going to mean that we're going to probably see home sales continue to go up, but at a little bit more slower pace in 2014. Good news is many parts of Idaho, you had stable houses, stable prices, didn't overbuild, but you get up in the Boise area, and that'll probably put a little bit more of a crimp on those individuals with mortgages underwater getting out of that situation. Big surprise this year has been the major surprise of, gee, we got some global currencies, global countries that are having economic problems, and their currencies are falling, and they're falling fast. On the list, Turkey, Argentina, South Africa. Wow, they caused a global ripple. That also was very much behind what the market was dealing with in January, in that investors didn't know, do these countries, are they going to affect the global banking system? Are they going to cause another banking crisis? Well, we saw classic overreaction, and guess what? Now in a couple of weeks, well, the currencies have kind of stabilized. Those countries still have their social, political problems and upheaval. It really isn't such a big deal. Next one is going to be the April 15th tax shock. Some of us are going to find we're going to pay a surprising surcharge on our tax bills and have to sell stocks. Companies are seeing a lot of higher costs related to 2010. Implementation of the Health Care Act, that's real. Guess what? It's an election year. I can't predict who's going to win or whether the House or Senate is going to change control, but we're going to see a ton of money going into those elections and national ads as both political parties fight for dominance. What that does is it takes mind share away from economic and financial things and focuses it on to advertisements, and typically advertisements are a tsunami of bad news. They're designed that way. Radar series on the radar screen, we enjoy some better growth. And finally, the two largest, the number 2 and number 3 economies in the world, they're in a food fight, political food fight. We've seen the escalation of talks in these countries. It's China and Japan. And they're basically going at each other over a bunch of rocks. About 200 acres worth of rocks out in the South China Sea. And you wonder, what in the world is going on? Why would they jeopardize their own military security and their economic security over a bunch of rocks? Well, guess what? There's about 200 billion unproven barrels of oil reserves around those rocks. They've had this jurisdictional dispute going on for about 2,000 years. So kind of interesting in that regard. I want to kind of wind up and just give you a little big picture. Not an archery target. I used this chart when I was here 2 years ago. When we look at, and it's kind of where we think stocks, bonds, gold, other things are positioned in terms of long-term cycles. And when we look at the stock market, we're saying we're coming into our 6th year of a bull market. We're getting a little bit long in the tooth, but we're really not frightened that we're up at the high noon bewitching hour quite yet. Bonds have kind of gone past that point. Gold is sort of at the bottom. Gold might be the surprise and actually have decent returns in the coming year. Real estate at the 7 o'clock mark, 8 o'clock mark looks pretty good for us, probably continuing to rise nicely. One of the things that I get asked about is what are you looking for, and what are you going to tell your clients? What are the tools that you're looking for, the indicators you're looking for that will take that green arrow and move it from, let's say, 1045 to 1145? What we've done is gone back over the last 8 cycles, covering 50 years. We have identified 12 indicators that all of them appeared at least 1 year before the stock market went into a major dumpster dive or the economy tanked. The good news is 10 of the 12 indicators right now are positive. I mean, 6 of the indicators are just solidly green. I'm not even worried about them. I do check them, I monitor them, but they are just solid green lights. I have in that list, I got the purple indicators. The 4 are things that could turn slightly negative this year, but are not a problem. And I only have 2 out of the 12 that are worry warts. One is the problems with some of the emerging global economies, and the second is we're watching a number of companies accelerate their activity buying other companies. And usually you see that close to the end of a cycle. The Fed is our friend. As long as that Fed continues to keep the monetary supply moving rapidly, businesses keep getting money, your customers are able to use their credit cards, you are able to use the credit cards to finance your inventory and payrolls, I think we're in pretty good shape. As we look at it also, we see corporate profit margins maintaining very, very high levels. I don't know how long they can do that without increasing wages and start hiring other people, but when we see that happen, that'll become a purple indicator. I know that there's a lot of small print up on the board. They're all big ticket items, and if anybody wants the copy of the entire presentation, let my colleagues at D.A. Davidson know, and they'll be happy to get it to you. With that, I'm going to come back and just say a little bit in terms of what we see happening in terms of, if you have any interest in the stock market, things that work well at this point in the cycle typically are what we call our cyclical indicators. Industrial companies at this point that are exporting and are producing cheaply and are taking advantage of 3D printing, robotics, technological improvements, have the ability to hire qualified people, ought to do fine. Energy looks to us to be robust, very attractively valued, a global commodity that will continue to be in demand, an area that if we can continue to find ways to get oil out of the Bakken field and the Marcellus fields, will continue to drive earnings for the oil companies, but is a huge natural resource. We love emerging technologies, materials. One area specifically of a classification of stocks, I absolutely at this point in time love companies that have long histories of increasing their dividends each year. Companies that have 10, 15, 20 years of annual dividend increases and were able to increase their dividends during the worst financial downturn that we've seen in the last 80 years, and that was during 2008 and 2009. Those dividend achievers ought to look very well. They technically lag a little bit in terms of the market performance on the upside. When the market turns down, we only see them go down about a third of the amount of the market to half. So those are some of the things that we see. With that, I'm going to end my presentation, say thank you. I appreciate being with you. It's fun being in Twin Falls. Good luck to your economy, and it's nice seeing a good, robust Rotary Club. Thanks for the warm reception. 2 minutes of one.
Thank you very much. I'll give you this gift.
Oh, thank you.